You will notice the problem we have here is one for about 3 years, I'm sorry, and we have a column for the books, which would be the income statement, and we have a column for the tax return, and that's for 2012. And then for 2013 we have the books or the income statement, and then we have the tax return, and the same for 2014. Now what we are showing here is how the income statement for a particular year under GAAP, and keep in mind that the books are using GAAP and the tax return would be using the Internal Revenue Code. And also keep in mind that a corporate executive would have as the objective on the income tax return to pay the lowest amount of tax, so they would want a low profit, and for the income statement on the books we would want a high profit in order to get an increase in our stock price. So keep that in mind, that a public company especially would want a high profit on the books and a low profit on the tax return. And the same is true each year, although we generally are thinking in terms of the first year with this particular objective, and then the later years just sort of take care of themselves as the accounting difference takes effect. So what we're going to show is one particular difference, and that involves depreciation. And we're going to follow a straight line. Notice that on the books for each year, for 2012, 2013, and 2014, we're using straight line. We bought an asset for $90,000 and we are depreciating it 1/3 each year on a straight line basis, so $30,000, $30,000, $30,000. For tax purposes, we will assume the company will elect Section 179, and that means they will expense the entire amount in year 1. So notice then in year 2, 2013, there is no depreciation for tax purposes, and then there's no depreciation for tax purposes in 2014. So we generally understand then straight line is preferred on the income statement. Makers or Section 179 is preferred on the tax return. Now notice the pre-tax profit is high for the income statement, $70,000, and low on the tax return for the very first year. Now you'll notice in the second and third year excuse me, that the tax profit is higher, and notice why it is higher. If we have the same amount of sales each year, that we have zero depreciation expense. And why is that? Because we took all the depreciation for Section 179 in year 1. The books continue to have depreciation, and as a result their profit now in year 2 and 3 is lower than the tax profit. But keep in mind that's not a problem, because we are achieving our objective in year 1. And what is that objective again? It's to have a high profit, a low tax profit, and consequently we would prepare an adjusting entry to that effect. So notice the adjusting entry for the books, and the adjusting entry that we're making here is only for the books. We're not making an adjusting entry per se for the tax return. That's not what we're worried about. We're worried about making the adjusting entry for the books. This is commonly called the tax provision. The income tax expense is known as the tax provision. And notice the debit is $28,000. How do we get that? We have a 40% tax rate times the book profit, and we get 28. And then the income tax payable is the amount of tax that we owe the IRS, and that's 10,000 tax profit times 40% to give 4,000. Keep in mind that the taxable income of 10,000 times 40% always gives the credit. So keep in mind then, and I will attempt to use a pen, that the credit to income taxes payable is based on taxable income, and the income tax expense is based on the book income. And so that's true in all the years. You'll notice the taxable income in year 2 is 100,000, and 40% of the 100 gives the 40,000 income tax payable, and the same is true in year 3. Taxable income times the tax rate always gives income tax payable. So keep in mind then that income tax payable is a check that is sent to the IRS. Now naturally we don't credit cash in the entry, and this entry is being made at December 31. As you know, we do not pay our taxes on the last day. We simply record the payable, and we'll pay the tax typically on March 15 of the next year. So this is called a deferred tax problem. Why is that? Because we're creating a deferred tax account, which is, you might say it's a plug account. It doesn't have to be a plug account. It is calculated. But that is the difference between the income tax expense and the income tax payable. Notice then there is a word, that a key term in this chapter, and it's called temporary difference. A temporary difference. And the temporary difference is a difference in the tax depreciation and the book depreciation, and that difference is $60,000. Again, that $60,000 is known as the temporary difference. If you multiply a temporary difference times the tax rate of 40%, you will always get the amount of the deferred tax. So once again, what is a temporary difference? It is the difference in either a revenue or expense on the books as compared to the tax return. You will notice the only difference is depreciation. So depreciation is different. It's lower on the books, higher on the tax return in year 1 only. Year 1 is known as the originating year. This is the year in which the temporary difference initially occurs. In the second and third year of this problem, it's called a reversing difference, because the temporary difference of the 30,000 switches, in the sense that there's 0 depreciation on the tax return, there's 30,000 expense on the books. So originating difference, the 30 and the 90, $60,000 temporary difference, and that's called the originating difference, and then the temporary reversing difference in year 2 and year 3. So keep in mind that income tax payable, always taxable income times the tax rate, and notice that's true in every case. The deferred tax liability in this case is the 60,000 times the 40% gives a 24. Or, as you see from this problem, the 24 is also the difference, of course, in the 28. That is the 40% of the book profit. So we will have another problem. We'll kind of review that, and then we'll talk about that in class.